the weaker dollar is a mixed bag because, as you know, currencies are relative, and if the dollar goes down against somebody, somebody else is going up against the dollar. Against the G10, there's the euro, there's Japan. Both of those regions have deflation. Do they want stronger currencies? No. So dollar weakness against the rest of the G10 probably isn't a great thing for anybody because it's a little bit like shuffling the deck chairs on the Titanic.
Yeah.
What you rather want the dollar to fall versus emerging markets. That would be a genuine loosening of financial conditions. It would help countries access global capital markets, and that would be a genuine positive. And I think, again, a lot of that hangs on risk premia and the vaccine.
Robin, what happens, though, if volatility continues to play out in the markets, if we get this risk-off mood extended here? I mean, what happens to the dollar's perceived status as a safe haven versus what's going on with the Fed, if you will, between this tug of war? I mean, what would win out?
Yeah, great question. You know, I was just looking through some of our metrics on financial market stress. You know, are there dislocations showing up like there were earlier in the year in the treasury market and cross-currency basis and so forth? And thankfully, everything looks good on that front. So we are not getting, in the context of the stock market sell-off, any signs of real stress in the system. But if we do go that route, and I don't think we will, but if we do, I would expect the dollar to get a strong bid again like it did earlier this year, right? And as I was saying, the dollar is still very elevated against emerging markets. So in the end, do I think that we have like a big loss of reserve currency status going on for the dollar? No, I think we've got fluctuations, we've got risk aversion. And if that risk aversion goes back up again, if, for example, the second wave in Europe is out of control, then I think the dollar will catch a bid.
Robin, just finally here, I mean, we kicked off this week, a very different mood for equities, and I keep thinking back to what Leon Cooperman was saying to our colleagues in the U.S., saying, okay, it's all fine and well, but who's going to pay for this party when it ends? When you look at this extraordinary policy from the Fed, when you look at other areas of the debt pile just growing, is this something that worries you, or is it just something that you push down, kick the can down the road, and we don't have to worry about for quite some time?
It does worry me. There is a mood, generally speaking, and I would say it's across the aisle, it's a bipartisan mood that there's really no limit to debt financing at the moment. And I think the discussion that we were having on the fiscal stimulus a little bit goes to that, right? We started out earlier this year with what were essentially supposed to be bridge loans for households and for companies. And here we are, we're talking about more of that, and there is no end in sight. And if you start talking in a room today in DC about debt sustainability, that's not a popular topic.
Right.
That's
Yeah, that's true.